A credit card can make you feel richer when you're actually becoming poorer. You walk into a store with $50 in your bank account. You see something you want for $300. With cash, you can't afford it. But with a credit card, sure, why not? One tap, purchase approved, problem solved. Or at least, that's what it feels like. Because the credit card doesn't make the $300 disappear. It simply moves the pain into the future. And if you don't pay that balance off, the future starts charging you for the past. This is the credit card trap nobody warns you about. Let's be clear. Credit cards aren't automatically bad. Used responsibly, they can be useful for payments, convenience, rewards, and building a credit history. The problem begins when you stop treating a credit card like a payment method and start treating it like extra income. Because that's when something strange happens. You stop asking, "Can I afford this?" and start asking, "Can I make the minimum payment?" Those are two completely different questions, and that tiny difference can completely change your financial life.
Imagine you want a new $1,000 laptop. You don't have $1,000 saved, but your credit card has a $5,000 limit. So you buy it. Your brain doesn't necessarily feel like you just lost $1,000. Instead, it feels like, "I'll deal with it later." That's the psychological power of credit. The payment is separated from the purchase, and when the consequences are delayed, spending can become easier. A $5 coffee doesn't feel like much. A $50 dinner doesn't feel like much. A $200 purchase doesn't feel impossible. But add them together, and suddenly your statement is hundreds or even thousands of dollars. The individual purchases felt small. The total wasn't. Now comes one of the most dangerous features of credit cards, the minimum payment. Let's say your credit card balance is $3,000. Your statement might show a minimum payment that's much smaller than $3,000. And psychologically, that can feel like good news. You think, "I only need to pay this much." But here's the catch. If you're carrying a balance, interest can continue adding to what you owe. So your minimum payment isn't necessarily a fast road to freedom. It can simply keep the account alive while interest continues working against you. And that's why the important question isn't what's the minimum payment. It's how quickly can I eliminate this balance? Because the longer expensive debt stays around, the more opportunity interest has to increase the total cost. Here's where the math becomes painful. Imagine you have a credit card balance, and your annual interest rate is very high. You aren't just paying back the money you borrowed, you're also paying for the privilege of borrowing it. And unlike a one-time fee, interest can continue accumulating while the balance remains unpaid. That's why a purchase that originally cost $500 can ultimately cost much more if the balance is carried for a long time. The product didn't become better. You didn't receive anything extra. You simply paid more for the same thing. This is why high-interest credit card debt can be so destructive to wealth building. Instead of your money working for you, your future income is working to pay for yesterday's purchases.
Here's another trap. Your credit limit can make you feel like you have more money than you actually do. Imagine your bank account has $2,000, but your credit card gives you a $10,000 limit. Suddenly, your brain sees $12,000 of spending power, but you don't actually have $12,000. You have $2,000. The other $10,000 is borrowed money, and borrowed money comes with conditions. This is one reason credit cards can make overspending incredibly easy. The limit isn't a target. It's simply the maximum amount the lender is willing to let you borrow under the account terms. Just because you can borrow $10,000 doesn't mean you should spend $10,000.
And then there are credit card rewards. Cashback, points, airline miles, free-looking perks. These can be useful. But here's the question. Would you make the purchase if there were no rewards? If the answer is no, the reward may be encouraging you to spend money you otherwise wouldn't spend. Imagine you spend $1,000 just to earn a small percentage in rewards, but then carry that $1,000 balance and pay significant interest. The reward is tiny compared with the potential borrowing cost. So don't let a 1 or 2% reward distract you from a much larger interest charge. The best reward isn't getting cash back on unnecessary spending. It's not paying unnecessary interest in the first place.
Now, imagine this happens every month. You spend more than your paycheck can comfortably cover, so you use the credit card. Then the next paycheck arrives, but part of it has to pay the previous month's balance, so there's less money available for this month. Then another unexpected expense appears, so you use the card again, and the cycle continues. Spend, borrow, repay, run short, borrow again. This is how someone can have a decent income and still feel permanently broke. The problem isn't necessarily their paycheck. It's that part of every future paycheck has already been claimed by the past.
So how do you break the cycle? First, stop treating your credit limit like available income. Second, know your interest rate and your balance. Don't blindly make the minimum payment without understanding what it means. Third, build an emergency fund, because unexpected expenses are one of the reasons people turn to credit cards in the first place. Fourth, if you're carrying expensive credit card debt, prioritize paying it down. And finally, before swiping, ask one simple question. If I couldn't use a credit card, would I still buy this? That question can stop a surprising amount of unnecessary spending.
Credit cards aren't the enemy. Using borrowed money without understanding its cost is. A credit card can be a useful financial tool, or it can quietly turn your future income into payments for your past. The difference comes down to one thing. Are you controlling the credit card, or is the credit card controlling you? Because the most expensive purchase isn't always the thing you bought. Sometimes it's the interest you paid long after you stopped enjoying it. And that's the credit card trap nobody warned you about. Subscribe for more simple explanations of money, debt, investing, inflation, and the American economy.